very much, Mr. Chairman. Let me, on behalf of Chairman Brown, recognize Senator Warren.
Thank you, Acting Chairman. I appreciate the help of the Chairman this morning. And thank you for being with us, Chair Powell. So Americans are struggling with rising costs, and all eyes turn to the Fed. Last week, you announced that the Fed would raise rates by 0.75 percentage point, the biggest increase in nearly 30 years. So let's talk about what the Fed is and isn't doing when it raises interest rates to try to bring down inflation. Let's start with gas prices. The price of gas is up 40% since Russia invaded Ukraine in February. Chair Powell, will gas prices go down as a result of your interest rate increase?
I would not think so, no.
Okay. That matters because gas prices are one of the single biggest drivers of inflation. Energy prices overall drove a third of the inflation last month, but the Fed's tools, as you say, have no impact here. So let's look at another necessity, food. Price of groceries is up nearly 12% this year. Americans feel the pinch. No matter how much groceries cost, people still got to eat. Chair Powell, will the Fed's interest rate increases bring food prices down for families?
I wouldn't say so, no.
Okay. So a Fed increase won't bring down these prices. And why? Because rate hikes won't make Vladimir Putin turn his tanks around and leave Ukraine. Rate hikes won't break up monopolies. Rate hikes won't straighten out the supply chain or speed up ships or stop a virus that is still causing lockdowns in some parts of the world. So let's talk about what interest rate increases can do. Chair Powell, you said last week that interest rate increases, quote, moderate demand. Can you just explain a little more about what that means?
Sure. So we think about interest rate increases as affecting financial conditions and then the economy through three broad channels, the first of which is interest-sensitive spending. So that's durable goods and automobiles and things like that. So interest rates go up, people's demand for as a result of higher interest rates will moderate or decline so that supply and demand can get into better balance. The second channel is just asset prices generally. Interest rates, as they go up, will cause asset prices to moderate across the economy, and people spend a little bit less out of their lower level of wealth. The third channel is the exchange rate, which is really just another asset price, and that just basically as the dollar strengthens. As rates go up, the dollar would strengthen, which would tend to drive.
So I appreciate this, and I do appreciate the explanation. But let me just see if I can just put a little more plain vanilla explanation of what's going on here. If I understand what you've said and what economists are saying across the board, is that when you raise interest rate, there's going to be less money to invest, and that is, it's going to dampen business investment. Is that a fair statement?
I think the idea is to
moderate
demand
to invest
so that it can be in better balance with supply. And
so
the current situation, demand is well in excess of supply in some areas of our economy.
More expensive to invest, which in turn is going to throw workers out of work. And when they're out of work, they have less money to spend. So I get that rate increases stop companies from spending money to build new plants or to buy new trucks or to hire new people, right, Chair Powell? When money's more expensive, they're less inclined to do that. I think that's what you just said on asset pricing, right?
Well, in the labor market, you have, as you know, you have a situation where there's a shortage of workers, and there are two job vacancies for every person who's actively looking for work. So part of this is to get the labor market back into balance.
Well, I appreciate you call it back into balance. What I'm trying to get at, though, is what does the tool of raising rates do? And part of what you just said is that it increases, in effect, the cost to invest, to buy those trucks or new plants or to hire new people. The reason I raise this and the reason I'm so concerned about this is rate increases make it more likely that companies will fire people and slash hours to shrink wage costs. Rate increases also make it more expensive for families to do things like borrow money for a house. And so far, the cost this year of a mortgage has already doubled. inflation is like an illness, and the medicine needs to be tailored to the specific problem. Otherwise, you could make things a lot worse. And right now, the Fed has no control over the main drivers of rising prices, but the Fed can slow demand by getting a lot of people fired and making families poorer. And while President Biden is working to increase energy supplies and straighten out supply chain kinks and break up monopolies and bring down prices, you could actually tip this economy into recession. So I just want to say, you know what's worse than high inflation and low unemployment? It's high inflation and a recession with millions of people out of work. And I hope you'll reconsider that as you drive this, before you drive this economy off a cliff. Thank you, Mr. Chairman.